Most people guess they spend around $40 a month on subscriptions. Bank statements tell a different story, closer to $127. That $87 gap isn't a math error. It's subscription creep. And 3 specific metrics explain exactly how those small charges compound faster than you notice. This pattern exists because of how recurring revenue businesses track success. While you see occasional line items on a statement, companies monitor every subscription through real-time dashboards measuring retention, revenue per person, and cancellation rates. Understanding these 3 numbers reveals why $7 charges multiply into significant annual expenses and why that process feels invisible until you audit your accounts. The term ARPU stands for average revenue per user. It's the total subscription revenue divided by total subscribers in a given period. If a streaming service has 10 million subscribers paying a combined $150 million monthly, the ARPU is $15. Companies track this metric daily because small increases, say from $14.99 to $15.99, multiply across millions of users. A $1 ARPU increase for a service with 5 million subscribers adds $5 million in monthly revenue. Your individual $7 music subscription feeds into that average, and when aggregated with everyone else's payments, it becomes a trackable, optimizable number on a finance dashboard. Churn rate measures the percentage of subscribers who cancel in a given period. If 100 people subscribe in January and 5 cancel by February, that's a 5% monthly churn rate. Businesses calculate this by dividing cancellations by total subscribers at the period's start. Churn is inverse to retention. A 5% churn rate means 95% retention. For subscription models, churn below 3% monthly is considered healthy. Above 7% signals trouble because acquiring new subscribers costs more than retaining existing ones. The forgettable nature of small subscriptions keeps churn low. People often don't cancel services they've stopped using simply because the charge is small enough to escape notice. Here's how these metrics interact with your actual spending. Imagine you subscribe to a streaming service for $12.99, a music app for $9.99, cloud storage for $6.99, a meditation app for $7.99, and a meal kit trial you forgot about at $69.99 every 2 weeks. Monthly, that's approximately $175. Annually, it's $2,100. Each service calculates its ARPU from your payment. The streaming service might have an ARPU of $14 across all users. You're slightly below average, meaning others are paying for premium tiers. The meditation app's ARPU might be $6.50 because many use free versions. Your paid subscription pulls that average up. Meanwhile, each company tracks whether you'll be part of next month's churn rate or if you'll renew automatically. Companies optimize ARPU through tiered pricing and add-ons. A basic streaming plan might cost $6.99, but ad-free costs $12.99 and 4K streaming costs $15.99. If enough people upgrade from $6.99 to $12.99, ARPU rises without acquiring new subscribers. This is why you see constant prompts to upgrade for just $5 more. That $5 multiplied across a user base significantly moves ARPU. Similarly, annual plans boost ARPU in accounting terms because the full year's revenue is recognized upfront, improving cash flow metrics even if the monthly equivalent stays the same. Churn reduction drives product design decisions. The harder it is to cancel, the lower the churn rate. This isn't accidental. If a cancel button requires navigating through account settings, then billing, then a retention offer screen, then a survey, then a confirmation email, each step increases the chance you'll abandon the cancellation. Studies show that friction in the cancellation process can reduce churn by 2 to 4 percentage points. For a service with 10 million subscribers, reducing churn from 5% to 3% means retaining an extra 200,000 subscribers monthly, subscribers who continue contributing to ARPU. Here's where subscription creep accelerates. Stacking effect. Each individual subscription decision feels minor. $7 for ad-free music seems reasonable. $12 for streaming is less than one movie ticket. $6 for cloud storage protects your photos, but these decisions don't happen simultaneously in your mental accounting. You subscribe to the music app in January, add streaming in March, sign up for storage in June. By December, you're carrying all 3, plus 4 others you added throughout the year. Each charge arrives on different dates. The music app bills on the 5th, streaming on the 12th, storage on the 23rd. This distribution prevents you from seeing the cumulative total in one place. Companies benefit from this fragmentation because bundled visibility would trigger cancellation behavior. A common misconception is that companies want everyone to use their service constantly. For certain subscription models, low engagement paired with low churn is optimal. A gym membership where half the subscribers rarely attend still generates revenue while reducing facility strain. A software subscription you use twice a year but don't cancel contributes to ARPU without creating support costs. This phenomenon is called passive subscribers, and it's factored into financial projections. Companies know a percentage of users will become passive. As long as those users don't churn, they remain profitable because the marginal cost of maintaining an inactive account approaches zero. Another confusion point, assuming ARPU represents what most individuals pay. ARPU is an average, meaning it's skewed by extremes. A streaming service's $14 ARPU might include millions paying $6.99 for basic and thousands paying $29.99 for premium family plans. The average lands at $14, but most individual subscribers aren't paying that exact amount. When companies report ARPU growth, it might mean more people upgraded to higher tiers, not that the base price increased. Understanding this distinction clarifies why your personal bill might not match reported ARPU figures, your one data point in a distribution. The interaction between ARPU and churn determines a metric called customer lifetime value, the total revenue a subscriber generates before canceling. If ARPU is $10 and average subscriber lifespan is 20 months, lifetime value is $200. Companies compare this to customer acquisition cost, how much they spend on marketing to gain one subscriber. If acquisition costs $30 and lifetime value is $200, the business model works. This math explains why some companies offer deep discounts for first months. Losing money initially is acceptable if churn stays low enough to recover costs over time. Edge cases complicate these metrics. Annual subscriptions paid up front create accounting questions. Does a subscriber paying $120 once count as $10 monthly ARPU or $120 in month 1 and 0 thereafter? Different companies use different recognition methods. Family plans where one subscriber pays for 5 users distort ARPU because the company might count it as one subscriber at $30 or 5 subscribers at $6 each for marketing purposes. Free trial conversions also vary. Some companies count trial users in subscriber numbers, lowering ARPU temporarily, while others exclude them until first payment. Subscription creep isn't a personal failure or a corporate conspiracy. It's an information asymmetry. Companies track ARPU, churn, and lifetime value in real-time dashboards. They run experiments testing whether a $9.99 price point has lower churn than $12.99, whether annual plans reduce total churn by 20%, whether reminder emails increase or decrease cancellations. You see a list of charges once monthly, maybe, if you review statements. The small size of individual subscriptions, each genuinely affordable in isolation, obscures the aggregate. $7 doesn't trigger budget alarms. $7 times 8 services times 12 months equals $672, which might. But you never see it calculated that way unless you build the spreadsheet yourself. Companies see their version of that spreadsheet every day, optimized to keep you subscribed. That's subscription creep in numbers. Small recurring charges, low churn rates, rising ARPU, and compounding cash flow that's visible on one side of the transaction and nearly invisible on the other.